Welcome to the weekly update, where I'll go over the action in the market for the week of July 17th through the 21st, and then we'll see how things look for the week of July 24th through the 28th. Believe it or not, we actually had an up week. Later in the week, it seemed like, oh no, maybe the market's going to fall apart. Well, it did look like we were becoming overbought, and the market right now appears to just be giving us a short-term pullback. If we start to see further weakness, we'll reevaluate things. In the bigger picture, we are still positive, just pulling back after having a nice run-up, and most of our charts are still positive overall. A few things just to start with before I get going. I do have a PDF that's available in the description below. I don't say that in the daily videos, but I do want to say it in this video because a lot of you don't watch the daily videos. I do have a condensed version of the daily video that I post each day. It's about 8, 10, 12 minutes or so, with an emphasis on the or so. Typically, the daily video is about 30 minutes or so. I try to keep it at about that length, but I know a lot of you are busy and you can't really take the time to watch a full-length video each day. Plus, maybe you don't need to. I do have a private Facebook group. If you want to join that, please feel free to send me an invitation for that. I have a new poll that I'll be posting this week after I get done with this week's video. And I do try to keep a real close tab on YouTube comments. I want the First Amendment to apply. If you disagree with something that I do or something that I say, that's okay. That's fine. If you want to keep it more private, at the end of this video, I do provide an email address for you. But at the same time, I want to keep the garbage comments and the bot comments away. And so if I see those, I delete them immediately. And I also post these same videos on Rumble. I use that as kind of a backup, or you could say YouTube is my backup to Rumble. I just like being able to post in multiple places in case something happens. Let's go back and talk about the week session. For the week, the S&P was up 0.69%. That might not sound all that impressive, but it was an up week, and it goes as an up week in the books. We did get finally above average with the volume. We're seeing a pickup. This past week, even though we ran into some trouble later in the week, folks are starting to come in and show a lot of volume. Now, Friday was options expiration, but we had been seeing above average volume before that day. The technicals are still positive on our weekly charts. We have some extreme positive readings. The market is really fixated on inflation and interest rates, and this is producing what's going to happen to growth down the road. That's the real focus of the market. We're also keeping an eye on the geopolitical events that are happening. We're also coming into the large part of earnings season now. And then this upcoming week, the Fed is going to announce what they're going to do with interest rates. They'll also have a press conference after that. Our trend is strengthening, and it is positive. And I'll show you the ADX chart of that later on. So for the week, the Dow was up 2.1%. The Nasdaq was actually down 0.6%. The S&P was up 0.7%. And the small caps, represented by the Russell 2000, were up 1.5%. We saw more of a broad participation in the market, and that is more healthy in the bigger picture. So for the week, here's some bullet points. The Dow extended its winning streak to 10 straight sessions. That's pretty impressive. But at the same time, some of those winning days were like minuscule, but it still goes down as an up day. The S&P hit multiple 52-week highs during the week. That's always a positive thing. The stock market had become overbought, and on Thursday and then a little bit on Friday, we're starting to see a pullback. Now, at this point, it looks like a short-term pullback, as I said earlier. We'll just evaluate this day by day to see if it turns into something more. But we're still looking healthy when we look across the broad market. There was a broadening out of buying interest this past week. The mega caps, which had been taking the market higher, they underperformed this week as folks were coming in to take some profits. Mega caps were down 1%, while the equal weight S&P 500, it was up 1.4%. Bank stocks also had a good week. The regional banking ETF that we watch was up 7.5%, and the bank ETF that we also watch was up 6.7%. There's a positive scenario that's still sticking to the market as of right now. Please be aware, this could change at any time, especially with the Fed coming out, and they're going to be talking more this week. The scenario that the market has right now could shift immediately. But right now, the market is anticipating that we'll have a soft landing. meaning that yes, we're seeing economic slowdowns, but we might be able to pick up again with the economy without going into a recession. There's a lot of evidence to suggest that we will go into a recession. There's also a lot of evidence that we won't. Right now, the market believes that we won't. There's also a belief that the Fed is close to done raising interest rates, and the market likes that, and that looking out into the future, earnings will still grow, especially in the second half of the year. Value did outperform growth. That's a little bit negative. In a good upward moving market, we want to see growth outperform value. Interest rates and the dollar were both up in the past week. And then Friday was options expiration. That added a lot more volume to the overall mix. So let's look at the poll results from the week ago poll. The first one is, as of Friday, July 14th, the S&P is extreme positive. Now, we still went up a few days after that, but at that time, I asked folks, do you feel that the S&P is due for only a pause, or it will start a significant decline? Folks were split, 50-50, then downward and to the left. I also asked, we are coming into a seasonally weak time of the month in mid-July. Do you feel that the market will stick to historical norms? 40% said that. The market will go above those historical norms, 40%. The market will go below those historical norms, 20%. Over on the right-hand side, the S&P and the NASDAQ 100 are hitting possible long-term resistance, and I have an update of those charts to show you later on. Do you feel that both indexes will break above resistance? 45 said yes, 55 said no. And then at the close on Friday, July 14th, there's a 93% chance that the Fed will raise rates 25 basis points at the next meeting. Do you agree with this or feel that the Fed may keep rates unchanged? 83% said that they'll raise rates, 17% that they'll keep rates unchanged. It's even higher than that now. It's like 98.2% that they're going to actually go ahead and raise rates. Looking at some Isabel Net blog charts. The first one showing the legal insider transaction ratio. We had been spiking up quite a bit. We fell down and now we're going back up, but we're not quite into bearish territory yet, where we use this as a contrary indicator when it gets to an extreme positive or negative reading. Just 4 hikes in July versus 34 in September of 2022. This is looking at the global central banks and showing how overall, across the globe, there are less rate hikes now than there were. There's been a strong tech inflow in the past 8 weeks. This has kind of been the trade that folks have been chasing after right now. So we're tending to see a lot of money going into the tech sector. Also, I drew the red line on here, but folks are still looking out into the future, whether it's Morgan Stanley or the consensus, that earnings growth is still intact for right now. This is an index that was updated on the 17th called the U.S. True Financial Conditions Index. It had been falling for quite a while. Now it's starting to come back up. You can read this 2 ways. It's negative 55. That's bad. It hit bottom, is starting to come up. That's good. So it's showing some kind of an improvement in the economy. Is this the tentative top for money market funds? There's $7.9 trillion right now in money markets. Is that going to keep going up? Also, the AAI survey that investors are deploying cash. The red line is the AAII investors who are increasing their cash allocations. As the market's been going up, they've been taking their money out of cash and putting it into the market. And it's not necessarily at an extreme reading right now. So a lot of bulls for the first time in a year isn't always a bad thing. This is after the AAII bulls go above 50%. And we did that after having been below 50% a year ago. And the returns looking forward are pretty much positive. Here's the green signal that was just recently generated. The largest inflows since May of 2022, bank loan flows. We're starting to see some money coming back in. Looking at some FactSet earnings blog posts here. Now, I have a few of them, some without any charts. The first one just says, the S&P will likely report a decline in earnings for the 3rd consecutive quarter in the 2nd quarter of 2023. Here's a chart to back that up. Here's where we're at right now over on the right-hand side. That's just a projection for right now. The gray area is what they think will happen. The blue area is what has actually happened. Here's another chart showing the earnings surprises percent over the 5 years. They're thinking that we're going to get back up into the future with the earnings projections. Then S&P 500 banks reporting higher provisions for loan losses in the second quarter. They're just showing a lot more loan losses than they were in the past. Then this next chart are provisions for loan losses against bank industry earnings. The green line are the earnings, and they're coming down just a little bit, where the provisions for loan losses are actually increasing a little bit. So we're seeing a little bit of improvement in this sector, but it's still kind of going in the wrong direction. Then S&P earnings season update as of Friday. Don't have any charts to show with this, just a couple of quotes that I took from their blog post. At this early stage of the second quarter earnings season for the S&P, the number of positive earnings surprises is in line with recent averages, while the magnitude of these earnings surprises is equal to the 10-year average. Okay, that's pretty easy to understand. Gets a little bit convoluted in the next paragraph. Overall, 18% of the companies in the S&P have reported actual results for the second quarter of 2023 as of the time of this post. Of these companies, 75% have reported actual earnings above estimates, which is below the 5-year average of 77%, but above the 10-year average of 73%. That's where I get a little mixed up here. In aggregate, when you take everything together, companies are reporting earnings that are 6.4% above estimates, which is below the 5-year average of 8.4%, but equal to the 10-year average of 6.4%. All right, let's get into our charts and talk about things. Here's the intraday chart where we did see the market move higher on Monday, setting a new 52-week high. We also set another new 52-week high on Tuesday. We topped out and went kind of sideways. The interesting thing about this, and I pointed this out in a daily video, on Monday we didn't see much of a gap from the previous close to the open. On Tuesday, not much of a gap, and then we went higher. Then everybody's jumping in thinking market's just going to go to Mars and beyond. We spiked up higher and just kind of went flat. That was the high for the week. We ended up coming down from there on Thursday and actually closing at the lower part of the range. Then on Friday, we gapped higher, pretty much traveled along the daily pivot, and ended up closing down below the daily pivot. So we were up overall, but it was kind of a choppy week later in the week. So for the week, the Dow was up the most, followed by the NYSE, the small caps, the mid caps, and the S&P, where you had the NASDAQ and NASDAQ 100 that were down on the week. Now this is just the 5 trading days for the last week. Going back to the beginning of the year, the NASDAQ 100 is in first place, followed by the NASDAQ and S&P. The mid caps are doing better, and the S&P small caps are doing better, as well as the NYSE and the Dow. All of the indexes are positive going back to the beginning of the year. When we go back to the all-time high, all of the indexes are negative, with the small caps and the NASDAQ still being down the most, but all of the other indexes are down overall. Looking at different sectors, this is for the week from Friday to Friday, where some of the weaker areas, they performed better this past week, where we had energy, healthcare, and the financial sector. They've been getting creamed earlier in the year. They were up the strongest this past week. And the areas like real estate, that's still kind of weak. But consumer discretionary and communication, which have been the leaders in 2023, they were down the most. And tech was just barely up, being almost unchanged. Looking at our relative rotation graph, where we have XLY, which is discretionary, it's in the leading area. Then we have XLK, which is tech, it's back in the leading area. Communication is starting to look a little more weak right now. It's going into the weakening area. The financials are looking a little bit better, and the industrials are starting to look a little bit better, but the other sectors are still weak when we compare them with all the other sectors. For the week, we had healthcare, energy, and utilities up the most, followed by staples and financials. These are the areas that got hammered earlier in the year, where we have tech, communication, and discretionary that were down. Again, these are the 5 trading days of the past week. When we go back to the beginning of the year, all of the sectors are up except for utilities and energy. Back to the all-time high, still energy is the one that is in the lead, followed by industrials and tech, with healthcare and utilities and staples being up slightly. All of the other sectors still remain negative. Looking at sentiment, we're getting extreme now. We're at 82. Anytime we get above 75, that shows a little too much exuberance right now, and is part of the reason we're declaring an overbought market. Historically, when we get up to this level, a lot of times we see a pullback. We got up to this level at the end of June, only to drop a little bit and then come back up. We're going to see, is this going to push the market down with more strength, or is it just going to fall back down to a more reasonable reading? The active asset managers, they're starting to look pretty extreme positive. That's another reason why maybe we're getting a little too excited on the upside. Now, these are professional managers, but they also manage other people's money, and they've got to show returns. And if they're getting caught off guard and the market's going up, they're going to have to jump in. They're human beings too. They act with their emotions. So we're seeing them a little too exuberant right now. Here's another reading of that same chart showing that we're at 99.05. Also for the VIX, we did see a little bit of a tick up on the line chart for the week as well as the bar chart. But overall, it's just showing that there's not really any fear in the market right now. The Ulcer Index is also very low, even though it ticked up slightly, suggesting that there's not a lot of fear. When we compare cash using the 1 to 3 month T-bills with the tech sector, in a positive environment, we want to see this black line going down. We ran into some trouble in 2022 with the black line going up. That means tech was really under a lot of pressure. If we look where we're at right now, tech is still performing well, and people are feeling a lot better about that, where for a lot of 2022, your cash would have outperformed what the tech sector was doing. Looking at the RIDEX bear bull ratio, we did tick down a little bit. As this goes down, that means people are more positive about the market. When it goes up, they're getting more fearful. We're not really giving any kind of an extreme reading currently. The American Association of Individual Investors are getting pretty positive about things now. Now, this data is a week old, so when it comes out, this is from the previous Friday, and we were doing really good things at that point. Individual investors who tend to follow what's already happened are getting a little too overexcited about things. Now, this could still go higher than this, but we are getting rather extreme. Looking at the economy, this is the latest reading from GDP Now, where they have us up at about 2.5% with the green line. When you look at the range of the top 10 and top bottom forecasts, we're at about 2% to the upside and about 0.5% to the downside, but they're both positive nonetheless. Looking forward for GDP, here's a graphical representation of that. And we're going to get a reading on that in this upcoming week when the advanced GDP report comes out. Looking at the spread between risky bonds and not as risky bonds, if we were running into trouble, this ratio would be going up. Instead, it's going down. And the correlation between this spread and the S&P 500 shows that they're going in opposite directions of each other. That suggests a healthy environment. The latest reading of the Financial Conditions Index, we're still below the black line. When we get nervous about this, it's when we cross above the black line. Also looking at the tightening standards for banks, unfortunately, this hasn't been updated since May 8th. That's one of the problems with government charts. They can give us really useful information, but about 3 months after we actually need it. The same thing is true with the real-time SOM rule recession indicator. Hasn't been updated since July 7th. We're still below the black line. We get nervous when we go above the red line. The smooth U.S. recession probability is also at the black line. We get upset when we're going above the red line. The Brave Butters Kelly Index. This is updated a little more regularly, but it's still kind of late now, where this is a bit of a concern. So we want to keep an eye on this chart, suggesting that we are seeing some potential issues with going into a recession. As far as inflation, we're pretty much flat. This measures the CPI inflation and core CPI, PCE inflation, which will be coming out at the end of this week, and core PCE inflation, and there really hasn't been a lot of change in that forecast. Keeping an eye on the Fed, 99.2% chance that they are going to raise rates 25 basis points at the meeting this week. There's a 0.8% chance that they'll keep them the same. That's where we're at as of right now. It really hasn't changed all that much. The dark blue area is where we're at now. This was a day ago, a week ago, and a month ago. So we've kind of been climbing up to this consensus that there's going to be a 25 basis point hike. The Fed balance sheet continues to decline, just as they said it was supposed to. So when we look at this on a year-over-year basis, it's also showing a decline. Now, looking at our charts, the breadth, we're above the moving average based on price and volume. That's positive. New highs, looking pretty healthy, turning back up with the fork, moving higher with the 10-week moving average. The advanced decline ratio turned back up and is above 0. That's positive. Accumulation distribution above an advancing moving average. That's positive. Looking at our trend, this is the ADX, where it's above its moving average and climbing. We're well above 20. The green line is on top and advancing. Just to give you a warning, we have a short-term ADX and a regular ADX that I look at every day in the daily videos. They're looking extreme positive, where this one is not looking extreme positive, at least yet. The Erin indicator, after giving us an extreme positive reading, has ticked down a little bit, even though it came up this past week. When the green line is on top, that means buyers are in control. When the red line is going down, that means sellers are having less of an influence. The oscillator down below measures the difference between the two. The mass index is not generating a signal right now, so I won't talk about that. Some other charts to look at. We came right up to this trend line and we've bounced back down just a little bit from that level. You can see for the last 3 days we've been above average with volume. But when we look at our weekly charts, we're coming right up to this R1 level with our pivot points. That could be offering some overhead resistance. We hit that level and started to come back down. But we still are looking positive. We'll have to see if we can get above this level. The trend channel, we're above the midpoint of the trend channel. That's showing improvement. We're above the 50-period simple moving average and advancing. The long-term trend for the S&P remains positive. The McClellan oscillator is above 0 and advancing. That's positive. The summation index based on price is advancing as well as volume, and neither of them are extreme yet. The Swenlin trading oscillator did decline based on price and volume, and we saw this in the daily charts until after Friday's session. Sometimes this indicator can be a good leading indicator for us, but sometimes it's also led us astray a few times. The PMO, which is a momentum oscillator, continues to advance. We're going up based on price and volume. The PMO study, it's almost an exact duplicate of what we're seeing on the daily chart. The percent of PMOs that are rising is still positive, but declining slightly, coming down a little bit with the buy signals, and starting to get extreme positive with the PMOs that are above 0. Now you can take this bottom part and read it two ways. We're getting extreme and due for a pullback, or, this is the percent of the S&P 500 stocks that are above 0 with their PMO readings. We've only been seeing a few stocks really adding to the upward movement of the market. To see this really going up means there's more broad participation. The Bollinger Bands, after going extreme positive, continue to decline. We're not giving an extreme reading right now. This is positive because we're above the dashed line. We're almost seeing this exact same thing on the daily chart, where we're showing good momentum with the bullish percent index. These are the number of buy or sell signals inside the S&P 500 based on point and figure charts. When this is going up, that means there's a lot of buy signals being generated, and we're seeing that show a lot of improvement. Yes, it is extreme positive, but at the same time suggesting good momentum. All of our oscillators continue to look more positive. The short term, intermediate term, and the long term. The chicken money flow continues to hold up fairly well on the weekly chart. We're seeing a little bit of weakness on the daily chart. It's still positive, but it really dropped on Friday. And this indicator tries to measure institutional buying and selling, or what is the smart money doing. The chicken oscillator turned negative on the daily chart, and it is declining here on the weekly chart. The force index, even though it was flat, continues to be positive. The money flow is looking extreme positive. The rate of change going back 1 week, we were up just barely on the week, so we're above the 0 line. Going back 50 weeks, we are coming down a little bit, but we were starting to get a little extreme positive. The RSI, based on 14 weeks, is still showing strength and not extreme, at least yet. The special K, it's negative right now, and I've been pointing this out in every daily video. The daily chart is positive. The weekly chart is negative, but see how the black line's starting to turn back up? If we see more follow-through strength, we could get a confirmation between the daily and weekly charts. The Stochk RSI is looking extreme positive. The Williams percent R also extreme positive. Ultimate Oscillator, after being extreme positive, has now started to decline. The Vortex has the green line on top and advancing and almost getting to an extreme positive reading, but overall this is still positive. The Copic curve continues to generate a buy signal on the weekly chart, and we're also seeing one on the daily chart. When we look at our Fibonacci retracement levels and long-term moving averages, we're well above all of those, so we're not in danger of hitting those unless the market loses like 500% in one day. Chart variations, the Heiken Ashi continues to be positive. The Kegi is positive and pointing up. The Renko chart is positive. The 3-line break is positive. We're seeing a little bit of improvement with the ease of movement on 14 weeks. It turned back up this past week. The point and figure chart, we added a new X this past week. That is positive. We're still working off an ascending triple top breakout that was generated on May 15th. Our different trading systems, the Heiken Ashi remains positive with green bars. The parabolic SAR is positive with the dots underneath. Some broad market looks. Here is just a generic look at the S&P, which is showing good strength. Seeing a little bit more strength with the mid caps, coming back up to a previous high. The small caps are lagging. They're not coming back up to those previous highs. The Dow continues to be in an uptrend. The Nasdaq is still really in an uptrend. The Nasdaq 100, we broke above this previous high, went up to a pivot level on the daily chart and have come back down slightly. We want to know, is it exhausted for right now, or is it going to be able to break out and go even higher? As I've been saying in the daily videos, a lot of our movement up was the Nasdaq 100 taking the other indexes with it. If the Nasdaq 100 starts to see some weakness, that could also mean it's going to take the other indexes down with it. We're just watching to see what will happen there. It doesn't mean that that's what's happening. We're just watching for that to happen. The mid caps are showing some improvement and are in an overall uptrend. The small caps, we finally have a confirmation on the daily charts when we look at the S&P small cap index and the Russell 2000 index. They're both showing golden crosses. We're getting close to a golden cross with the weekly chart. The NYSE also in an uptrend, all stocks in an uptrend. The 30 biggest software companies in an uptrend. The FANG index did set a new all-time high, but then broke down below that and closed below that level on Friday. ARK was actually down on the week, even though it's been showing some recent strength. We're seeing an uptrend on the daily chart and now an uptrend on the weekly chart. Looking at Dow and Dow theory, we've been really watching the transports a lot, and they're starting to confirm each other, where the Dow is finally starting to break out a little bit. The transports are showing a lot of improvement, and the utilities are underperforming, but often that gives good support to the S&P 500. The bank index had a really good week this past week. We're starting to go back up above 50 with the RSI, and the MACD is turning up. And deposits for all commercial banks is showing some improvement. Looking at the broad market, the CRB index was up this past week, but continues to be in a downtrend. Oil is bouncing back up to about 77. Copper has been showing some weakness, but on the weekly chart, it's still in an uptrend. It switched over to a downtrend on the daily chart. The dollar, after dropping below 100, was able to get back above 100 to close on Friday. Gold is still in an overall uptrend, but has been showing some weakness. Silver also showing some weakness, but continues to be in an uptrend. Looking at bonds, where we're going pretty much sideways with our total bond ETF. Stocks continue to outperform bonds on the monthly chart. And looking at the MOVE index, this measures the volatility of the bond market, and it decreased slightly. This is a daily chart. The VIX ticked down just a little bit with the slight update that we saw, and that measures stock volatility. And looking at the bottom, the relationship between the two is very strong. We're also keeping an eye on this, but I may drop this chart at some point. This is the 1-month yield, and we subtract the 3-month yield. We should get a negative result, which is what we're getting right now. It was going all crazy right around the time of the debt ceiling issue. Looking at a daily chart of U.S. yields, where we were declining a little bit earlier in the week, but then we started to go back up later in the week. This is a weekly chart of international rates. The UK has the highest rates, but they've been coming down, followed by the U.S. and Germany. And as I always say, Japan's down here in red, land of the rising sun. We will keep an eye on this. We're keeping an ear open for news that may come out of Japan at some point that could drip over and feed into the U.S. market, but it hasn't done that yet. Some relative studies. First, we look at how are the different markets doing going back to the beginning of the year. Stocks are in first place, followed by gold, bonds, and now the dollar has turned back positive. Oil has been negative going back to the beginning of the year. If we go back to the all-time high, oil is still in the lead, followed by the dollar and then gold, where stocks and bonds continue to be negative. The NASDAQ 100 to the S&P 500 ratio is in a strong uptrend. They're both doing well, but the NASDAQ 100 has been doing even better. The S&P 100 fell back a little bit this week, but is really outperforming the rest of the S&P 500. Growth is outperforming value. We saw a recent golden cross here with this ratio. Gold is starting to really underperform the S&P, and we're actually seeing a death cross in this ratio. And we're also seeing some weakness with the dollar. Even though gold's still in an uptrend, it's been having a difficult time really breaking out. Bonds are really underperforming stocks, and the low volatility stocks are really underperforming the S&P, where they outperformed in 2022. Energy to tech shows that energy is underperforming tech. Discretionary is now starting to outperform the staples sector. And looking at our long-term secular, which can mean decades, versus cyclical, which might mean years, trend studies. First, we look at the NYSE breadth thrust. It generated a signal in October of 2022. Then we're coming up out of that. This signal is more indefinite and longer term and remains in the background. Also, the ZWAG NYSE breadth thrust was generated back in March after it had an extreme negative reading and then immediately went to an extreme positive reading. This is also indefinitely on the books and remains in the background. We're also looking at the NYSE Zohorchak method, where it had been negative in 2022 and a lot of 2023. It still is generating a buy signal. This is some new charts that I presented last week. This is a weekly chart based on a log scale of the S&P 500. Here is the 2018 top and the 2020 top. We extend that out, and it looks like we're running into some resistance right here. Now, we're slightly above that, but this is a weekly chart, and it's going to take a little bit of time for this to work out. We just want to be aware of this and keep a close eye on it. We're also watching a very similar chart on the NASDAQ 100, going back from the 2009 low up to where we're at right now. We have been able to break above that. Can we stay above that and continue to go higher? We also keep looking at the NASDAQ 100 to Dow ratio. When this got really high, it was back in the dot-com boom. And then what happened after that was the dot-com bust. It took us 20 years to get back up to this level again. And then this is the beginning of 2022. Actually, it was late 2021 when we started to see some weakness. We're flirting with this level again. We could still continue to go up and maybe even break above this, but we just want to be aware of this in case we run into some trouble. Also, looking at the weekly chart of the S&P and comparing it to the DAX weekly chart, where the DAX set a recent all-time high, the S&P hasn't done that yet, and the correlation is starting to wane just a little bit between the two. Our historical studies, I go through this every week, and I might drop this at some point because it's becoming less relevant. When we go back to 1998 to 2004, it looked like a couple of times we broke above this trend line, only to fail. If you look down at what the MACD was doing at that time, it wasn't really confirming that upward move. We saw the same thing from 2007 to 2010. We broke above this trend line. The MACD was flat. We ended up failing. Where are we at now? We broke out a number of months ago, and the MACD was positive at that time and continues to be positive, suggesting that this breakout above the trend line is more legitimate. And actually, it's been going on for quite a while now. So like I said, I may stop showing these charts for a while. So what's the outlook for the upcoming week? This is the economic calendar. We've got the FOMC announcement and press conference on Wednesday. That'll be at 2 p.m. Eastern. On Thursday, we're getting the first reading of GDP. And then on Friday, we'll be getting the PCE personal income and spending, as well as the PCE prices, which is what the Fed really likes to look at as far as inflation is concerned. Looking at the Stock Traders Almanac statistics, we are coming up to the week after options expiration. We're 50-50 whether we're up or down. Just for July 24th, which is Monday, we're negative for the Dow, we're neutral to positive with the S&P, and neutral to negative with the NASDAQ. We will be on the 15th trading day of the month, where we're chopping around a little bit, but we sometimes see some weakness going into the latter part of July. We're also keeping an eye on the NASDAQ. It's coming up to the midpoint of July. Historically, there has been some weakness after this. Doesn't mean we're going to actually do this. This is just a guide that we use to give us an idea of what historically has already happened. So our scenarios for Monday, we're not going with the down one because the technicals are very positive. Even though they're still overbought, we don't really want to shift to a more negative stance until our charts confirm that, and they're just not doing that right now. If anything, we still default to the positive side, but we're a little leery of that because we are overbought. They may limit the upside, but we still would default to that anyway. And we're not going with the sideways trend right now because on all of our different ADX charts that we look at, it suggests that we are in a trending mode. The green line's on top, and that trend is positive. So our warning signs, this is based on Friday for Monday's session. We're seeing a convergence of some short-term bearish signals, and we're still keeping an eye on these. This is the S&P to VIX ratio. Also, the 5-period simple moving average of the equity put-call ratio, that's starting to get a little extreme negative, and sometimes that marks a top. The negative divergences, specifically in the NASDAQ 100, and we're also into a seasonally weak time of the month. The longer-term trend signals, those weekly charts that I showed you, they could be signaling that we're at a top, but we don't really know that yet. We need more of this to play out. We're at a seasonally and historically weak time of the month. The oscillators are negatively diverging, but they're really improving on all the charts that we look at. It's the NASDAQ 100 that's turning a bit more negative. The VIX is still showing that there's not a lot of fear in the market. The cumulative new highs, new lows for the NASDAQ are still showing weakness. We're still above the level that we set with the 3-month yield right before the great financial crisis. S&P 500 growth is still in an uptrend, but it's weakening. And then we're in the middle of earnings season. Some positive signs. The seasonality and setups, those NYSE breadth thrust charts and that Zohorchak chart that I showed you, those are still in the background. The long-term special K chart, daily version, is positive. The weekly chart is still negative, but it is showing some improvement. The longer-term equity put-call ratio is positive because it is declining. The S&P remains above a downtrendal upper line. I haven't been showing that chart because we're far away from that line. We're still in a risk-on posture, meaning that folks are favoring stocks over bonds. Lower price levels may provide support, but we really haven't tested those all that much. So far, we can say they're holding. If we do see some more weakness, we're really going to be watching those levels. Those can be pivot levels, a previous high, a moving average, across any of the indexes. We'll be watching for that. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're above that longer overhead resistance, but on the daily chart, they hit pivot resistance and have been coming back down. The Staples to S&P 500 ratio is declining, and the Russell 2000 as well as the S&P Small Cap Index, as well as the mid caps, are generating recent golden crosses. Small and mid cap growth continues to be positive, and the Copic curve has generated a buy signal. So our conclusion, this is just for Monday. The S&P remains positive, but as of right now, it just looks like it's working off being overbought. We can say that same thing for the short and intermediate term. The long term, we still remain positive. Then before I end this, I just want to show this to you. This is put out by Tom Bowley for the month of July, where energy tends to be weak, tech tends to be hot. We're past this beginning of the month now where we were up 25.91%. We're coming into the weaker part of the month. We're going back to the year 2000. We're down 13.85%. And then later in the month and are up 21.07%. When he goes back 20 years, the Qs have outperformed the S&P 79% of the time of the Julys that were counted, and they've outperformed by 1.1%. Thank you. I hope you found this helpful. Please feel free to check out some of the daily videos. I will be preparing the intermarket analysis video. I hope you have a wonderful weekend, and I will talk to you in the next video.